Hi, I'm Kylie Mattu and welcome to Wealthy Millionaire. Today we're going to talk about everything you need to know about preferred stocks. Before we start, I'm not a lawyer, I'm not an accountant, and always make sure that you reach out to your trusted financial advisor for any financial advice. When looking to invest in the stock market, there are two broad types of stocks you can pick from, a common stock or a preferred stock. We're going to look closely at what a preferred stocks are all about and the reason why investing in them makes sense. So what is a preferred stock? Preferred stocks are the securities of any company or organization which gives an investor the ownership right, but not any voting rights to the investors in exchange for a capital invested. Preferred stocks pay a higher dividend in comparison to common stocks. When the company experiences robust earnings growth and profit, then the company decides to distribute the money to investors through a dividend, and the dividend is much higher than the common stocks. In other words, the company pays dividends to preferred shareholders before common shareholders. Stockholders enjoy added security and privileges common stockholders never have access to. For example, in the event that a company folds, common stockholders will get their payment only after all preferred stockholders get their cut first. On top of that, if you own a preferred stock with a company, you'll get your dividends in a timely manner, unlike common stockholders, which may fluctuate. As such, preferred stock offers the holder better security and thus lower risk than common stockholders. So what is a preferred stock? They typically work in almost the same way as a bond does. Their holders get paid fixed dividends at common time intervals. So if you're looking for a fixed income investment to put your money into, a preferred stock is a place to look. Common stock, however, it doesn't work that way. Another way that common stocks differ from preferred stocks is that the preferred stocks are heavily dependent on interest rates, and so they tend to fluctuate. And moreover, preferred stocks are characterized by what is known as a par value, and these are units of the stock that can be redeemed and later purchased back with a certain time frame, and that's typically around 5 years. Lastly, in the event that an accumulated dividends on a preferred stock aren't paid over a period of a year, it amounts to arrears, and these arrears technically are known as dividends in arrears on a cumulative preferred stock. What we need to know about preferred stocks is if flexibility is at the top of your list of criteria when looking to pick a stock to invest in, preferred stock is your best bet, and due to this flexibility, preferred stocks offer higher dividends than bonds. And that's not all. Preferred stocks actually enjoy better longevity than bonds do. Or as investment experts like to say, preferred stocks are perpetual. And what does this mean? Simply put, it means that preferred stocks can remain valid forever. And unless the company repurchases the stock, it remains outstanding forever. A couple other things you need to know or should know about preferred stocks is that they can be easily converted to common stock. This means that if you own preferred stock, you can convert them to common stock at a stipulated price. But valuing convertible preferred stock should be done by an investment expert. Second, dividend payments can be delayed or even skipped altogether on a preferred stock. This means that if a company is unable to pay dividends to its preferred stockholders, no legal action can be taken against them. However, dividend payments can be skipped on non-cumulative preferred stocks for their cumulative counterparts. Dividend payments can only be delayed but never skipped. So let's compare preferred stock versus common stock versus bonds. Bonds, preferred stock, and common stock are all investment vehicles that can have future contracts to secure your financial future. However, they are distinctively different, even though they may have lots of common ground. So to begin with, companies issue all these three financial instruments for the same reason, to raise money to run their business. But due to the costly nature of common stocks, many companies tend to shy away from it, opting for preferred stocks instead. Investors on their own part, they tend to favor preferred stocks for a number of reasons. Chief among them is that preferred stocks yields a better return on investment, especially for beginners. And though preferred stockholders tend to enjoy better steady income revenue, they are at more risk of losing their investment than those that are invested in bonds. A common stock. So the reason why it's called a common stock is that holders of the stock are usually the last to receive their dividends once a company starts paying out. Even worse, in the event of liquidation, common stockholders will be the last to get their money back, and that is if there's anything left for them. Common shareholders have the lowest priority of getting any of their money back when companies fail. So creditors who lend the money to the company, they typically must be paid in full before any shareholder. Even if there's something left over after the creditors have gotten paid, preferred shareholders will stand ahead of common shareholders. In the face of these drawbacks, what would make anyone want to invest in common stock? Well, it's simple. If a company remains profitable, common stockholders enjoy unlimited returns on their investments for almost forever. So no cappings. Common stock obviously is paid after preferred shares, and preferred share stockholders get their dividends. But when the dividend is first established for the preferred shares of a stock, it's typically at a higher yield from when it has been paid out currently in the market. But if you're the owner of a common shares of a stock, you're owning common shares for a long amount of time, say 5 years. And if the company continues to grow, your dividend as a common shareholder might actually become a better dividend than what the preferred share stockholder is getting. Then we have a preferred stock. It often looks a lot more like a bond, as it typically has a set dollar amount that the company can pay preferred shareholders to redeem the shares. It's called preferred stock for a reason. Investors tend to prefer them over the common stock, and an investor prefers this type of stock because it enjoys the special treatment from the company using it. The label preferred comes from two advantages that preferred stock has over common stock. A company must pay out dividends to preferred shareholders before common shareholders receive any dividends. If a company fails and its assets get distributed to investors, preferred shareholders must receive a fixed amount of money before common shareholders can get any of their investments back. These attributes make preferred stock especially attractive for investors who primarily focus on income. Most preferred stocks won't see large price increases even if the company that issued it is very successful. But preferred stocks have a major drawback. A company can decide to skip dividends payout on it, and there's nothing anyone can do. On top of that, the return on it is somewhat limited. So out of all three investment instruments discussed so far, bonds enjoy the highest level of security and stability. The reason is, before paying out dividends, the law stipulates that a company must first pay interest to a bondholder, and furthermore, in the event that the company folds up, bondholders will be the first to get back their investment capital, even before preferred and common shareholders are given a thought. There are times when a conflict between shareholders and bondholders arise. Oftentimes it happens when a company makes huge financial gains and bondholders are left out. This is because more often than not, the contract between the bond issuer and the bondholder stipulates that only the shareholders can benefit from a corporate gamble that pays off. So how do we buy a preferred stock? Although preferred stocks can be bought on stock exchanges, just like the common stock, this isn't the case most of the time. To buy this type of stock, you'll need to check with a bank or an insurance company. It's recommended that you consult with an investment expert before purchasing a preferred stock. You don't want to watch your money sink because of a bad investment decision. Most investors, they want stocks as investments because they're interested in long-term growth for their portfolios. For them, common stock is usually the better choice because they care more about seeing their shares grow as a company succeeds. For growth-oriented investors who like the features of preferred stocks, choosing a convertible preferred can also be a smart move. If your primary focus as an investor is a current income, preferred stock can give you more of what you're looking for. I hope you enjoyed this session. I'm Kylie Matu. Thank you for watching Wealthy Millionaire. See you next time.